Wall of worries or wealth of opportunities. After 2 years of being battered by oscillating between lockdowns and normalcy, the Indian economy seemed poised at the start of the year to continue steadily on the trajectory of recovery and growth. However, the joy was short-lived when in February, the world woke up to the largest conventional military conflict since World War II. Russian President Vladimir Putin announced in a public address that he had authorized a military operation in Ukraine. On the domestic side, India's retail inflation skyrocketed for the 7th consecutive month to an 8-year high of 7.79% in April this year. While a sizable chunk of the population has been feeling the pinch for a few months now, the global supply issues in food and fuel triggered by the Russian invasion of Ukraine, the heat wave in India that led to a spike in the prices of perishables, and the scars left from COVID have accelerated the rise of inflation rates to record highs. The RBI, in a bid to tame inflation, increased the repo rate by 40 basis points and the cash reserve ratio by 50 basis points. Now, for the community of retail investors, the present poses multiple undulations on the investment terrain. So how do you navigate this volatility? That's what we are here to find out. I'm your host Gautam Srinivasan, and today we have a special session lined up for you in association with Aditya Birla Sun Life Mutual Fund on whether the current circumstances should be looked at as a wall of worries, or is there a wealth of opportunities that can be made use of by investors. And we have with us three stalwarts from the market. Let me quickly introduce them to you. A Balasubramanian, MD and CEO, Aditya Birla Sun Life Mutual Fund, is here with us, and joining him is Mr. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC Limited, and with him is Mr. Kaustubh Gupta, who is the co-head of fixed income at Aditya Birla Sun Life AMC Limited. Gentlemen, it's great to have you on board, and I'm looking forward to hearing your insights and perspectives and, of course, expertise on the topic. But Bala, we'll start with you. Considering the environment that we are in, the war between Russia and the Ukraine is already in its 4th month. There's global inflationary pressures happening. The food crisis is worsening. Supply chain disruptions, they continue to loom large. Now, as such, the undercurrent of volatility that is expected to stay for a while. So for a lot of the investors who are wondering how to navigate this, what do you think will be the medium term impact of these issues?
The way one has to look at is what came, especially the war between Russia and Ukraine, that came all of a sudden. I think it took the world by surprise, and therefore it led to many things, as you rightly said, rising inflation, and growth momentum got stopped, and then economic opening up of trade, that is to drive the economic growth, also taken a back seat. In some sense, you can say from a growth expectation point of view, we have gone behind by about, say, a year or so. But having said that, one should always remember, after a very substantial rise in the equity market, which you have seen between 2021 and even 2022 for some period, we saw actually a substantial rise, especially 1920 and 2021, we saw a substantial rise. Whenever market moves at such a fast pace, the market goes through some bit of corrections. That's why historically, if you see, market goes through ups and downs. As I've been in the market for long, none of the fall will tell you and come. Another rise will tell you and come. I think that remains constant all the time. And that's been the fundamental principle in which the market operates. The current uncertainty that now it's of course created some bit of volatility in the equity market. I think you have seen a significant volatility setting in the last almost 2-3 months. Probably I think we are in the fag end of the volatility getting reduced, and then discussion about inflation getting moderated, growth coming back. All the discussion I think will be coming back very soon. The question is how long is going to take. But that is being the case from investors' point of view, or even for money managers' point of view. One has to of course look at investment as not something I'm making for 1 year or 2 years. I'm making this investment for, say, 10 years or 15 years. Therefore, one has to use this opportunity, in fact, to accumulate the investments in mutual funds rather than getting worried about it. That's the way market functions.
Your 3 decades in the market have made you an optimist, an eternal optimist. Fair point. But Mahesh, coming to you, looking at all these variables at play, whether it's inflation, whether it's geopolitics, it gives rise to uncertainty. And while Bala is optimistic that the volatility is going to reduce, there's still going to be a lot of questions in the minds of investors, especially from a, say, short to medium term perspective. So, in your view, what should investors be watching out?
So I think this period, what we have seen in the last 4 months or so, has been unprecedented, right? In the sense that, I mean, at the beginning of the year, we were knowing that the whole policy thing, I mean, the whole liquidity and the low interest rate environment which was there, that is going to really normalize, right? That was expected. So this year was expected to be a year of consolidation for the market, because last 2 years, the euphoria what we saw because of huge amount of liquidity and valuations went up, they were supposed to normalize. But because of the war which you mentioned, right, there was a disruption and we saw inflation really shoot up beyond control. And that really prompted the central banks globally to really be more hawkish and to increase interest rate at a much faster pace, which then started to hurt growth, right? Because, I mean, earlier the central banks were looking at growth and inflation, but preferring really supportive for growth. But because inflation went beyond, like in US, it was almost like 4 times their target inflation against 2%. It was kind of a 30-year high at 8%. So that became a priority of tackling inflation, and that in turn has resulted in terms of slowdown in growth. Global growth has been downgraded by around 100 basis points. In India also, you will see some downgrade to growth. So I think what investors should be really looking at is inflation, how it behaves from here, because I think the worst of the inflation seems to have been priced in over here. The key question is how soon it comes down from here, right? Because the long-term target of inflation, say, which Kaustubh would probably highlight it further, is much lower. And that will determine in terms of how much tightening happens, right, on the monetary side. And then and the market will probably take a cue from there. So I think one is the overall earnings because of the slowdown. What is the impact on earnings growth? Because finally, for the market really to do well, corporate earnings and profit growth has to sustain, because that's what drives the market from a longer term perspective. And that has been fairly strong. I mean, last 2 years, despite the COVID crisis and the slowdown in terms of growth, we have seen fairly strong profitability growth. That is kind of slowing down. Globally, we've seen downgrades to earnings. In India, we haven't seen that much, right? Because a lot of sectors, India never really caught up as fast in terms of recovery like what we saw in the developed markets, right? We are still growing slightly below our long-term trajectory growth pre-COVID what it was. So a lot of sectors are still coming up and they will continue to slowly improve from here on. And that's why the earnings growth is still looking fairly healthy, even for fiscal year FY23, which will be somewhere in the mid-teens or so. So as long as the corporate earnings growth is still fairly fine, I think the markets, while they will move up and down, because whatever we may say, finally markets are linked to global factors, right? If the global markets correct, we will see the impact over here, and we've seen a fair bit of correction in the US market. So that volatility and gyrations will be there. But if earnings growth downgrades are not much, inflation, okay, if like it's looking to peaking out, commodity prices if they start to come down a bit, and oil is something which I think is a key monitorable, because that market is still very tight. We have seen metal prices started to come off now, right? I mean, steel prices in India also the government has export duty on steel, and we've seen almost like 10,000 rupees per ton steel prices coming off, so that should help. But I think oil prices still remains a pain point, and I think recently, yesterday itself, okay, there was a meeting in Europe about what kind of sanctions, okay, whether on Russian oil they will put. So I think the situation still remains tight over there. So if oil remains around say $100, $110, $20, we are still okay. But if it goes up, then it's again one more factor to really worry.
Absolutely. Lots of variables at play, but broadly you see there's still a lot of fuel left in the tank for the India growth story to move ahead.
Pretty much. I think See, at the beginning of the year when we came with the outlook, we said India's time has come. A lot of things have fallen in place. I mean, in the last 4-5 years, 5-6 years, we have seen a lot of reforms which were also disruptive. Now is the time to really reap the benefits of that. But because of this issue, there is some setback, there is no doubt about that, and it will take slightly longer, but the long-term story for India still remains very much intact.
All right, the long-term story remains intact. Kaustubh, coming to you. You're in the fixed income space. Usually surprises are rare, but we have seen some surprises, especially the rate hikes which came in, which many wondered, where are things going, because it's a global phenomenon, right? June, July, we saw the Fed rate hikes happening as well. So considering how things are panning out in the fixed income space, what would you first say to investors as your initial talking point here to them as you address them as to what's going on?
So look, for the first time in last 24 months, fixed income is now becoming an investable opportunity. Now the COVID response, both in advanced economies and emerging market economies, was sharp policy response both on monetary and fiscal front. Being emerging markets, our ability to do large fiscal was limited, which is why large part of heavy lifting was done by monetary policy by doing a deep rate cuts and infusing extraordinary amount of liquidity, which this country has never witnessed. Now, as things are returning to normalcy, there is need to remove these ultra accommodative policies, and which is why RBI is trying to do. One can argue that RBI should have moved much prior. There was a general consensus view within the market participants as well. But given that the growth inflation dynamic in the country is still feeble, and especially as you rightly pointed at the inception of this conversation, that what is very certain today is the volatility and the risk part of it. Now what this does on the volatility part of it is that it reduces your growth potential and it increases your inflation probable scenarios. The risk premiums into inflation goes up. Now this, in Indian context, yes, the inflation has gone up from probably last 15-20 years of 6% to closer to 8% today. But look around that the deviation of US is from 2 to 8. So our deviation of inflation was somewhat limited, which was giving some comfort of RBI to support growth as long as possible. So one can say that RBI has started late, but RBI is on right track, and because of which now fixed income is becoming first time an investable opportunity for the investors in last 24 months.
All right, but when they see the yields hardening, what do you tell your investors as to when they see these numbers and then they get worried? What would you tell them?
So I'll say that there are a nuance point here, in the sense that of course Fed has moved just twice, RBI has just moved once, but markets are moving ahead of central bankers. As we speak, markets in India, they are already factoring that the RBI will take repo rate to 7% by June of 2023. Now think from a backdrop that in last policy they hike CRR, in last policy they hike 40 basis of repo. Prior to that they have introduced the SDF, which was a tightening of 25 basis point. So effectively 65 basis point of rate hike has already been done. Markets are factoring another 250 basis point in a matter of 12 months. So markets are already baking in reasonable higher amount of steep action by Reserve Bank. So the risk is well priced in. Now when the risk is well priced in, it is not a risk, it's an information that the markets are trying to give, that what is the probabilistic scenario that the central banker is going to take to. So in that, if the risk is well priced in, we need to pick up the points where the risk in our assessment is well priced in, and those points may be an opportunity rather than risk incrementally.
Absolutely, and where there is adversity, there is opportunity, and the
Yes.
smart investors know that as they stay in the markets. But taking forward some of the points that Kaustubh mentioned, let me bring you in, Bala. The first repo rate hike since August 2018. So what does this portend for, say, different asset classes, and how can investors reap benefits in your opinion?
I think the way historically it has worked, whenever the interest rates moves up, then naturally it provides an alternate to the investors who otherwise don't consider investing in fixed income as an asset class when the interest rates are low. So definitely the 40 basis point hike in CRR, 40 basis point hike, as Kaustubh mentioned, the expectation of market also now a steep hike would come in as we move forward. Then naturally the market start discounting it. So that narrow between what he called as the earnings yields in equity and the bond yields narrows. Basically the earnings yields actually used to be say X and bond yields used to be Y. If that actually the bond yields become better than the earnings yield in generally, it actually leads to a revisit to asset allocation. Therefore, fixed income now will become part of the consideration from investors' point of view. Second is, if you look at past return, last 1 year or 3 year return, if you see, because interest rate has been rising, therefore some of the schemes would have given relatively lower return or maybe negative return. That also should be seen as an opportunity because the portfolio yield goes up, and therefore for the future investment point of view, it makes sense actually allocate investments into the debt funds. So from an asset allocation point of view, while equity is an asset allocation, the way I look at the whole allocation into 4 parts. The mutual fund provides an opportunity for every investors for 4 different type of needs. One is a savings needs, which is nothing but liquid fund. Second, your income generation is nothing but an income fund. And third is actually the growth that you have to get in terms of wealth creation that comes through the equity funds. And fourth is actually tax saving, which comes with the LSC schemes. If you look at the mutual fund product offering that all of us have offered, it actually takes care of the 4 different needs of the investors. I think one just keep in mind when you do an asset allocation, all the 4 parts which should play a role in your portfolio consideration, then your overall asset allocation is taken care. Irrespective of whatever the interest rate where it is, irrespective of whatever the equity market where is it today. I think if you're able to build a design covering all the 4 different type of categories, and then choose the schemes in each of the category, and then make asset allocation, it takes care of the entire need of the investors. Let the market go wherever it is. As long as I highly disciplined in terms of asset allocation, I don't need to worry about what is going to happen to the market tomorrow.
But at the end of the day, you do need a blueprint to navigate this market. So that's been provided by you. But merging some of the talking points which you shared, Bala, with what you said earlier, Mahesh, about the earnings aspect. When we look at rising interest rates, we see its impact on profitability, share prices, cost of capital rising. So from your perspective, what can investors do to ensure that their short and medium term goals, they have that certain direction, they know where it's headed? What's your view on this?
So from a equities perspective, right, see what really matters is the growth. I mean, interest rate increase in the initial period, of the monetary policy is not so much restrictive because it doesn't really impact growth so much. And what we've seen is that corporate India, to a large extent in the last 2-3 years, has seen a significant amount of deleveraging. So say if you look at corporate debt to equity ratio, that has been at the lowest point what we have seen in many years. So the impact of increase in interest rates on the profitability of the corporates is not as much. I think what really matters is if the growth, because of increasing interest rates, there is a slowdown in growth. That really what matters on the profit growth much more. We have seen increase in interest rates, but it's still not really as restrictive as it would be. The challenge for growth has been more about the supply side issues, which are really bothering that. So I think in the initial period of the rate increase, we have seen that in the earlier period also from 2003 to 2008 when rate increase started, but growth was very strong and the earnings growth also was very strong and the markets did very well. Only when the interest rate starts to really tighten and when the growth is at its peak, then it starts to hurt. So we are still slightly far away from that. So I would not be too worried in terms of corporate profitability because of the current increasing interest rates. It has some impact in terms of valuations because in a low interest rate environment, markets tend to value, the P multiples tends to be on the higher side because you are discounting future earnings at a much lower rate. So that P normalization is happening and which is bound to happen, as I mentioned earlier this year. And we've seen the multiples across companies, especially some of these high P, high growth stocks, which had gone up in a very low interest rate environment in the last 3-4 years, that has started to now correct. So that normalization is happening. And so I think in the current environment, I would say that for investors really would be to really focus where the growth is. If the slowdown in growth, there's a lot of talk about global growth slowing down, US going into a recession, and to what extent that happens, I think that is what needs to be really focused on. There could be short-term impact on growth because of the current sudden tightening, but one has to look at from market perspective, you look at growth beyond the next 1 year, right? Because equity is all about investing, and I mean the stock prices don't discount 1-2 year and discount earnings for the next 10 years or even 15 years. So I think that perspective, I think if it is still okay, I think one should not be too worried about these rate increases, and any correction in the market and normalization in valuations, okay, makes the markets more attractive, right? And the markets were expensive. Now I think the markets are coming into a fair zone, and that's what I think that's what you want companies' prices to be, in the fair price, so that you can make decent returns from a long-term perspective.
Absolutely. If you speak to some global investors, they would look at the PE normalization, say it's about time this happened.
Yes.
Fair point. Kaustubh, coming to you, when we look at fixed income, right, the image, or you could say it's the myth that it's only for conservative investors, but actually its value is very, very required from a stable and resilient portfolio perspective. So considering all that volatility that we are seeing in the equity space, how do you think fixed income instruments now fit into the picture for investors?
So look, the obvious argument is about asset allocation, that in any saver's profile, you need to have multi-assets which can give you some bit of diversification benefits and some bit of stability of returns as well. Now, unlike equity, where the returns are quite volatile and there is a expected equity premium which is investor expect at the time of investment over the bond yield, in case of fixed income, the main objective is more to do with savings and stability of return. So that's the obvious argument. But I'll go one step beyond that and I'll say that we have a history that unlike advanced economies, in India, there are every 4th or 5th year there are crises in terms of policy making. Now these crises, they give us the opportunities time when investors can actually log in and they can extract significantly better return than what our interest yields will reflect. Now when I am coming to say that if you look at an income fund, long-term income fund, that is a fund house that we have offered, the long-term returns are closer to 9 to 10% of last 10 years and 15 years. Now this is exceptionally return, given that there is no amount of equity risk kind which is being built into it. It's a straight sovereign paper and it is giving a yield. Now that's true for not only for India, it's more or less, it has been true for last 30 years globally as well, because globally interest rates have generally, they have come off quite sharply and secularly. In between there are bouts, for example you can say in 2011, maybe in 2015, maybe in 2017, maybe today when USTs are trading at closer to 3%. If you are of the view that generally the world, there is a headwinds in terms of demographic dividend, there is a headwind in terms of productivity growth, there are headwinds in terms of stock of debt that this world has accumulated, it's very difficult to assume that rates can be taken significantly higher. So we have cycles in fixed income as well, and if you are able to capture cycle well, not only you will able to get the fixed yield or the stable return that you are looking for, there could be moments of opportunities when the bond yields or the fixed income market will compensate you significantly above that, and I think the time is very near. Given today the equity risk premiums are much lower because the bond yields have come off, and which is why fixed income needs to be part of your asset allocation more convincingly, also from a wealth perspective, apart from stability of return that you are looking for.
Absolutely, and there are cycles not just in fixed income but in every investment that you see. And Bala, you've seen so many cycles come by with your experience. So for considering, crests and troughs are part and parcel of any market or economy, what would your advice be to investors on how they should think about these cycles as they look at their investments?
I think if you look at the history, I think market goes in different territory and then consolidates at a level and then keep moving up. I think if you look at the long-term trend is up, but intermittent volatility is bound to be there for variety of reasons. It could be related to interest rate, it could be related to war, it could be related to the economy slowing down, it could be related to recessions, it could be high growth that is coming in. Various things actually drive the market. None of us as an individual, despite being in the market for so long, you will never be able to get our asset allocations right, or never will get a call on the market right. What you can get right is only on asset allocation, which is nothing but to look at every investment that is being made in equity. You are investing for say next generation types. I think you have to clearly think about, I'm investing for 10 year or 15 year. Therefore, investing by way of SIP and a continuous interval, I think will be key to the success. However, fixed income portion concern is a cushion. For everyone needs some cushion in the portfolio to volatility. That fixed income component of portfolio, when you have an asset allocation model, definitely acts as a cushion. When interest rates moves up today like this, when the equity market goes through a volatile period, fixed income actually supports in terms of adding to the overall portfolio comfort. I will not say significant return or wealth creation, it's a comfort that comes in. Therefore, both asset classes will remain 70 to 80% of the portfolio. One is for long-term wealth creation, one is for a stable return of portfolio, which acts as one cushion during the volatile period. Also is available for you to redeem, not at a loss, at a reasonably a good profit. But an equity, at we panic, there will be a time where we will redeem the investment at loss. In a panic, you redeem and the market turns volatile. Whereas the equity is supposed to be meant for long term. I think if I understand these two aspects of investing as a principle, then most of the investors, I think, can make the investments more peacefully without worrying about market volatility.
And that's where goals are important, because then you don't keep looking at the market returns, you look at whether you are reaching your goal through the use of financial instruments. Fair point there, Bala. And taking that forward, when we speak of balance, Mahesh, I mean, the economy grows, but sectors, there's uneven growth, right? Some grow more, some grow less, some are exponentially growing. So this question gets asked to you in a lot of media forums. Which are the sectors to watch out for, in your opinion?
Yeah, so I think, see, last year it was more about all global sectors, right? There was a sharp rebound after the COVID in the global economies because of the stimulus. We saw commodities do well, metals do well, some of the exporters did very well, right? IT sector also did phenomenally well. I think going forward from here, there are more challenges on the global front is what we see. India also there are some headwinds, but not as much. And India growth recovery will be slow and steady from here over the next few years. So domestic centric sectors is what I think we would be more positive on. And from that perspective, if you look at banking and financial is a good proxy to India growth story. And the banking sector overall has gone through a lot of pain in the last few years. We have seen the NPA cycle peak out. Incrementally, corporate balance sheets are much better, so we don't see that impact because of NPAs on the P&L, and valuations are fairly reasonable. Credit growth is now slowly picking up, so that sector looks good for us. Apart from that, auto sector has gone through again a lot of pain. It's still, even pre-COVID, it was slowing down, and the impact of the higher commodity prices. I think both these things are kind of impacts are waning now. Commodity prices are coming off, and we are seeing some recovery over there. I think rural economy, which was also affected last year after the second wave of COVID, I think this year looking at the farm incomes, because food prices are higher. I mean, that's one kind of a fallout of the Russia-Ukraine crisis, but which will benefit the farmers, right? Your wheat prices are up, cotton prices are also significantly higher. So rural economy, if it comes up again, that will drive a bit of consumption also. So I think autos, for example, even industrials, we have seen, I think there are some green shoots of capex picking up after a long time, private sector capex, and I think because of the India's focus on Make in India and the production link incentive schemes which the government introduced a couple of years back, that is slowly gaining traction. So I think you would see some recovery in the whole private sector capex. Okay, not immediately, but if I take a 2 to 3 year view, and a lot of industrials or capital good companies should benefit out of that. So I think these are the sectors, okay, which look good. I mean, both from a valuation perspective and also in terms of growth outlook over the next 3 years.
All right. Well, those are the sectors that should be included in your portfolio. And as our Prime Minister says, Aapda mein avsar, which loosely translates to opportunity in adversity. Every market cycle brings with it certain opportunities which we as investors should look for. And of course, moving from equities to debt, because when we look at the benchmark 10-year government bond yields, I think 7.42% was the highest since May 2019. So, explain to the investors how they should approach that number, when they look at fixed income investments, how should they make sense of it?
Look, again, as I told in the earlier conversation, that we need to identify if the risk is well priced in, it's no more a risk. But if the risk is not well priced in, then we need to wait for markets to price risk well. Now, when I'm saying that markets are pricing in 7% of repo over course of next 12 months, the shorter end of the curve, which is 1 year, 2 year and 3 year specifically, which are more influenced with get liquidity and what's happening on the RBI rate action plan, they are baking in steep rate hikes, and it seems that the risk is well priced and it makes sense. Now, but when one comes to the longer end part of the curve, which is beyond 4 and 5 year, and specifically on the benchmark curve that you spoke about, we do think that the risk is not well priced in yet. Let me explain why. Now, the first point is that prior to COVID, the consolidated fiscal between center and state was more closer to 8%. Now, that number shifted to closer to 14% into COVID, and even this year it is expected to be closer to 11%. Now, and that doesn't include any kind of probable fiscal slippage that we are staying at because of increase in food and fertilizer subsidies and excise duty cuts. But this is a large shift from 7% to run rate of 11 to 12% for course of next 5 years. Now, commensurately, the saving profile of this country has not changed. As such, in this country, the saving profile is largely between 1 to 5 years. Nobody wants to invest for 10 years, very large and substantial portion. There are institutional money which do come in, but the basic saving profile is still not ready to fund that kind of fiscal deficit, and which is why the longer end part of the curve is undergoing a technical readjustment where the demand is clearly understripping the supply. Now, last 2 years that didn't hinge us, that didn't pinch up much because RBI was very proactive in terms of liquidity, in terms of support through open market operations, and by keeping rates too low. But now that all tailwinds have now turned headwinds for this year. Now, because they have become headwinds, and on top of it with elevated inflation because of commodity driven, and as a country we are heavily dependent on these food and fertilizers and energy which accounts for nearly 2/3 of our entire CPI baskets. No way from a financial stability perspective RBI can stay accommodative and to make sure that the orderly evolution happens in a very timely manner, and which is why our base case is that as far as the benchmark yield is concerned, of course we think that over course of next 3 to 6 months it should start touching more closer to 775 to 780 rather than where they are today. So in our assessment that risk is not well priced in, so one should still be away from it. But as far as the shortened part of it is concerned, which is 1 to 3 year, because they get more influenced by RBI action, because they get more influenced with liquidity which is still accommodative and likely to stay accommodative, because they are getting more influence with the credit growth which is still somewhat lower than the historical experience of 15 to 20% of previous up cycles. This shorter end we think is an opportunity, and that's where the investor should flock in. They should invest in these funds. For example, we have now launched series of index funds, predominantly sovereign index funds, which are at elevated yields targeting between these 1, 2 and 5 years, or rather specifically 2 and 4 year. So these are right opportunities. Till the time the benchmark yield curves reaches closer to this 775 to 8, I think investors should still stay away from it. Meantime, they should invest in short term. Once the benchmark yield comes closer to that level, which is where in our assessment at least a fair level, or at the fair level at which RBI will come very actively to support yields doesn't yield inch up, that's where the investors start making some bit of allocation in the longer end from both stability perspective and long-term income generation perspective as well.
All right. Well, seems like an era ago when we were speculating whether those yields would be 6% in September last year, but here we are. But something which Kaustubh said, which is that the savings profile hasn't changed. And Bala, the heat of inflation is coming in, and that can make it difficult for the common man to stick to their investment routine. So in that context, what would you say to investors and how they should stick to meeting their financial goals even in this very hot inflationary environment?
See, there are 2-3 things which has happened. I think last 2 years people have become extremely conscious about how do they spend and where do they spend and how they go about doing savings part. That's something I think have improved the savings rates in the country. Second is, as Mahesh mentioned, rural economy is doing reasonably all right. From a common man point of view who are dependent on rural agriculture economy, there has been reasonably increased level of income arising out of the agriculture activities which Government of India has been encouraging, of different type of agriculture income has to be generated. Third, I think is about the social security systems which the Government of India has ensured that money reaches the common man. Therefore, money in the hands of people is not lower, actually on the contrary, it is higher. So that is being the case. In general, the savings rates have gone up, not just only in India, even globally also has gone up. And from an inflation point of view, yes, the inflation is higher in certain pockets of the product or services, such as fuel prices has gone up. Therefore, there is a level of impact in the common man purse. At the same time, there is one factor which remains all the time is the wage inflation. As this thing happens, naturally the wage inflation goes up. That's why if you see globally, one of the challenge that most of them have got is actually how to cope up with the wage inflation rise. So that to some extent takes care of that. I think inflation rise, as long as wage inflation is commensurate with the increase in inflation, therefore from the common man point of view it takes care. But at the end of the day, from an investment point of view, come back to the same discipline. So from a common man point of view, even is able to save 500 rupees, 1000 rupees, 1500 rupees per month in the form of savings, while of course he carries out all the other activities from spending point of view, then he is able to actually simultaneously build his investment portfolio from a longer term point of view. I think one of the things that I always say is some of the expenses which normally incur, like buying a pizza, we don't care, we don't mind paying say 1000 rupees or 2000 rupees. The same way you apply a similar principle when it comes to the question of making your SIP. Consider this as expenditure, not as an investment. And then leave it as it is for generating, for it to create a longer term wealth. Then that takes care of the most of the needs of not just of common investors, even the middle class investors.
Absolutely. Maintain the discipline, but we'll also explore what it means from an asset allocation perspective, considering on May 21st, Union Finance Minister Nirmala Sitharaman, she announced a slew of measures to slay the inflation monster, which included reducing central duties on petrol by 8 rupees a litre and diesel by 6 rupees, giving 200 per cylinder cooking gas subsidy to 90 million poor households. Now that move is expected to cool off inflation in the coming months, but the added strain on the common man's pocket may take some time to ease off. So Mahesh, I'll come to you for your perspective. Do you think investors need to revamp their asset allocation strategies, and if yes, what are the things that they should keep in mind in your opinion?
So I think each investor should know what is his right asset allocation depending on his risk profile, right? And the kind of investment horizon what he has, or the goals what he has. So that is, the individuals will have their own target asset allocation. At the current juncture, the way things are, it also talked about on the debt side, also things are now starting to look, or probably the next 3 to 6 months will start to look fairly attractive. Equities had a good run last 2 years, valuations were higher, they are correcting now. So it's in a fair zone currently, and there are some headwinds which are there. It's not likely that you will see a kind of a one-way rise in the equity markets. We are seeing volatility. There could be some more downside from here. Investors should be prepared for that. And so given that, I would say, a few years back, we were target because of the good financial conditions, saying that you should be slightly higher than your target equity allocation. That means if your target equity allocation was say 50% normal, you could have been higher than that. And this is the time to now create a balance, right? So you maintain your target, don't go overboard on equity at this point in time, though equities still look attractive from a long-term perspective, but near term there would be headwinds. So you maintain your long-term target allocation and spread out across asset classes. I think the risk reward is fairly well balanced, I would say, between equity, between debt, which was not the case earlier. So stick to your target allocation. I think that should be fine. And any market volatility which comes in, right, it gives you an opportunity automatically then to, if equity exposure goes down, automatically then rebalance that back to your target allocation. I think that is what I think one should do, not try to really go aggressive at this point in time.
Now is not the time for creativity.
No. Yes.
All right, Kaustubh, let me get your viewpoint in as we look to wrap up this conversation. Given that there is still some time for inflation to tilt into benign territory, what are the debt fund options that investors should be looking at right now? Recapping some of the options that you mentioned earlier.
So it's just that because the shorter end point looks reasonably well priced in, so we do think that investors should flock into these index funds and target maturity funds. These are sovereign dominated risk which is underlying in them. So effectively there are no credit risk, because generally RBI and the sovereign have ability to print unlimited amount of money. In terms of spreads, if you look that 3-year sovereign paper spread with repo, it is at a decadal high. In terms of liquidity, anytime investors can flock in. and they can get out. Unlike FMPs in previous avatar, where investors don't have exit options, here investors can actually come in and come out anytime. The most important part of it is that if the investors are staying for 3 years, because the inflation for next 3 years is still likely to be closer to 6% rather than below, the benefit of indexation will be immense, which means that the most likely the taxation, post-taxation yields will be significantly better off in these fixed income portfolios. Now, as a generic principle, what I would say is that because we are living in a highly uncertain environment and the volatility is paramount, it's prudent that the investor need a better ALM in their investment strategy. For example, which means that if the investor profile or the ability to take the volatility is for short term, which is 3 to 6 months, then the funds like money markets, ultra short term and low duration, they make a lot more sense. If investors have 1 year money, then they should look for funds which are moving in the duration of 1 to 1.5 years. Because the only way to actually adjust your wall is that you get hump over the time period, so that if intermediate walls are there and because of which there are some mark to market losses, because of potential higher yield and because of the maturities which are generally silos, the returns will be lot more stable if the investment is made in line with your investment horizon. So that's the mother principle. But in terms of curve, because the risk is very well priced in 3-year sovereign papers, which includes both GSEC and SDLs, I think from that perspective, especially for the retail investor that we are speaking about, they should flock in into these index funds between 3 to 4 year maturity and gets benefit not only of our indexation but also of elevated yields which the sovereign papers are providing today.
All right, options, strategy and advice. We've covered the entire gamut for investors. On that note, it's time to wrap up our special presentation, and I'd like to thank all of you gentlemen for sharing with us your treasure trove of information and knowledge. Now, shifting sands will always be a perennial feature in the journey of investments, and they may present us with opportunities or challenges. Decoding these movements become easier with a balanced outlook, tempered with the right degree of optimism and pessimism. Thank you so much, ladies and gentlemen, for joining us. Till next time, this is your host Gautam Srinivasan signing off. Have a great day.